You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver, Moritz Siebert, and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Now, for long-term investors or listeners, I was actually meant to say our conversations are intended to keep you focused and inspired to continue your trend-following journey. And for those who are newer to the show, our hope is that today's episode will trigger your curiosity to check out the back catalog of all the episodes you may have missed. Rob, Moritz, great to be back with you this week. How are things? How are you doing?
Well, it's good to be back after a few weeks break. I was quite listening to last week's episode with Nick Leeson, who is pretty famous. I mean, even my kids have heard of him, so that was pretty exciting. So I hope I can match that this week.
Hey Niels, hey Rob,
Hey.
How are you? Doing fine. Great to have you on.
Yeah, no, and absolutely, Rob. Nick was a great guest. Thoroughly enjoyed the conversation, and it was different. So I hope if you haven't listened to it yet, just go back 1 week and listen to our conversation with Nick Leeson. In terms of a market wrap this week, I picked up a few quotes from our friend George that I wanted to share with you. The first one is from David Tepper, where he is out saying the market is pretty high and the Fed put a lot of money in here. The market is, by anybody's standard, pretty full. Maybe the second most overvalued stock market I've ever seen. Obviously, David Tepper, famous in the hedge fund world. And the other one is from an equally famous hedge fund manager, is from Stan Druckenmiller, who was out saying, the consensus out there seems to be, don't worry, the Fed has your back. There's only one problem with that. Our analysis says that it's not true. I'm not a scientist. I'm a common sense guy. I just don't think you can take massive amounts of money, allocate capital to some big companies. It just doesn't make any sense to me. So that was Stan Druckenmiller. And of course, we know that when these people are proved right, of course, all the experts will say, oh, but no one could predict all of this. In other news, as they say, yesterday we heard from the Fed. They were out saying that the coronavirus pandemic has created a fragile U.S. financial system that could last some time. And earlier this week, actually, Fed Chairman Jerome Powell had already warned that, and I'm quoting, a lengthy downturn could turn liquidity problems into solvency issues. Something actually that I personally think will happen. And by the way, solvency issues can't be fixed with lower interest rates because the companies, they will need revenues at that time. But despite these gloomy comments from the Fed, investors struggle, I guess, to seem to make up their mind. You know, one day this week we had the Dow down by 500 points, and the next couple of days it's all recovered. But, you know, for those who are looking beyond a few days, Bank of America, they released its view on the world and what it will look like after the COVID-19 upheaval. And they were out saying, we expect the pandemic to accelerate many macro trends that would have taken 5 or more years to play out before, from peak globalization to renewed tech wars and reappraisal of healthcare systems and government influence. And that's what they are out saying. And of course, you could also read it as we all face less privacy and health may be the next wealth. And I do agree that this will accelerate many macro trends, which should be good for those of us who are operating strategies that are broad-based in terms of markets and agnostic to whether markets go up and down. And indeed, they did this week, Moritz, as usual. We're always interested to hear what was up, what was down in your world this week.
Many things were up, actually. I was putting it in our Slack group. I made 77 basis points positive this past week. It's 2.79% up year to date. And some of the good positions this week were short positions in hogs and copper and net gas and live cattle. And bad was a short position in cotton, and really, really bad was a short position in milk and a short position in silver. So silver short, gold long. I think I've mentioned that before. That is still the positioning of my system. It may change, but it is what it is right now. And what I found remarkable when I had a look at the portfolio is that 78% of all the positions that I had on made money in the past week, which is an unusually high number for my system. It's normally a bit more equally distributed. And still the P&L is only 77 basis points, right? Even though such a large percentage of my positions made money, which shows that the two bad losing positions that I had, milk and silver, they were really large losses. And of course, I got stopped out on milk with a 0.8R loss, and on we go. That's the next 1,000 trades. Also, the portfolio has changed a bit. When I looked at the best performing markets year to date, they're now still WTI, the short position of WTI has been there for a while. And then long positions in the US 10-year rates and Canadian bank bills. And the three worst performing markets are now silver and also platinum in addition to milk. And platinum is a complete 180. Platinum was a superstar performer in the fourth quarter of last year and for pretty much the start of this year. And probably the best performing market in my portfolio, it's now among the worst. This is the nature of the beast.
Oh yeah, absolutely. And it's but tell me a little bit more. I'm just curious. I mean, you say you trade milk. I mean, how much liquidity is there in milk these days?
Yeah, there is a bit of liquidity. I mean, we've had a question I think a couple of weeks back on butter and some of those markets. Those I don't trade, but milk is a contract that I can trade with my size. It's probably not a contract that you would trade with an institutional portfolio that has billions because there's just not enough liquidity for that type of money. But, for my PA type of trading, systematic trend following, those markets, orange juice, lumber, milk, they're all fine.
Cool. Very cool. Rob, as you said, it's been a few weeks. It's great to have you as always. And always very exciting to hear what's happening in your portfolio because, of course, it looks a little bit different than ours. So Tell us about what's been going on.
I mean, actually, it's almost a repeat of what Moritz said. So over the last week, I'm up about 3%, about 12% for the year. Actually, since I last spoke to you guys, the profit's much smaller. So I kind of lost a bit of money, and the last week actually has been pretty good. And similar story, really. Actually, I mean, I haven't got many positions on, and we talked last time about partly some of the reasons for that. Partly being I've got much less capital. But actually, yeah, I've got sort of half my positions made reasonable money, and there's nothing really standing out there. I mean, some of the similar names that Moritz has mentioned, so natural gas, lean hogs, heating oil, all reasonable positives for me. What's also quite interesting is because I haven't got many positions on, I've actually got quite a lot of spare margin in my account, and actually that is contributing to the P&L in a couple of ways. The first way is that my account's denominated in GBP, and I'm holding margin obviously in various other currencies, mainly dollars and euros, to cover potential futures exposure. And because the pound did very badly over the last week, because maybe we're not doing such a good job with this coronavirus, that actually made me about a third of my profits over the last week. And also, as most people do, rather than just keeping the cash as cash, a lot of it's actually invested in short-term, in my case, short-term US Treasury bonds. And that actually made a bit of money as well because interest rates in the US have continued to fall in the sort of 2 to 3 year point. So actually, it's not really a story of making 3% in futures. It's more a story of making about the same kind of money as Moritz made, but actually the cash pile in the portfolio is so large that's actually swinging the P&L as well.
I mean, that's pretty interesting, but you said 12% year to date. I mean, that's phenomenal, really. Where, if I don't know if you have those numbers in front of you, but whereabouts kind of year to date have you done well? And because part of your portfolio is a long only, right? It's a long only portfolio, and so it hasn't been easy all year.
I'm just focusing on my futures trading. Actually,
I
try not to look at my long only, partly because it's depressing. Partly because
but 12% futures wise, that's fantastic as well.
Yeah, I mean actually I made 12% in January pretty much, and I've been flat ever since. I kind of started to make quite a lot of money when the market sold off in March, gave it all back, and it's kind of just been reasonably flat ever since. So, it's a classic kind of trend following account curve. You make a lot of money very quickly, and then you're just trying to hang on to it until the clear trends appear. And right now, just looking across my portfolio, there's not really any sign of any clear trends there. Just smallish positions in not many markets.
What volatility are you targeting, if you're targeting volatility with your futures portfolio, Rob?
That's the other thing. I'm targeting 25%, which is probably higher than most institutions target. So you'd expect the absolute numbers to be higher in my portfolio anyway. On a risk-adjusted basis, it's probably pretty similar.
But still, I would say you've done really well so far this year, because even those that are at that level of volatility, certainly there are a few people who are up that so far this year. So great stuff to hear. I mean, of course, not surprising, a lot of what's already been said in terms of this week, very similar on our side. We did see an uptick in performance this week, nothing crazy, but it was nice. May is back in the black, which is great. And if we look at the details, frankly, crude also was the biggest loser on our side, as it recovers from these historic lows, and another show off this week with a 20% gain. But actually, and energy was, as a sector, the worst area for us. But again, even within energies, nat gas did really well. So we talk about energy as like it's the same thing, but it's really not. So that was interesting. All the other sectors pretty much made a little bit of money. Currencies, maybe in particular, all the markets individually made money that in that sector, mostly from the strengthening of the greenback. So risk as well, moderate. We're running a little bit below our long-term average in terms of value at risk. So yeah, I mean, ticking along, nothing too crazy, nothing too exciting. But given the fact that we get, or investors get a lot of volatility elsewhere in their portfolio, I'm sure they don't complain if they look at our side of the allocation and don't feel they have to spend too much time in terms of worrying about that. So that's good news. Now, of course, as there is a lot of things going on at the moment, we always try and find some topics, and Rob found some quite interesting topics, mainly from what other people have posted recently, but it's obviously along the lines of the things we usually talk about, but perhaps in a slightly different way. And so I'd love for you, maybe Rob or Moritz, whoever want to start out. But the article we're talking about is Straddles and Trend Following. A piece that Nathan Faber wrote, but it's from the Think Newfound organization, Corey, who's been on the show. So, Rob, it caught your attention. Do you want to kick it off and talk about kind of the way you see it, and I'm sure we'll have some other views, other thoughts about it.
Yeah, I mean, it's kind of related to a topic we touched on last time, which is this idea that a lot of people buy CTAs because they perceive them as a kind of disaster insurance. But also there are kind of funds which are explicitly disaster insurance funds or tail risk funds. And the main difference between these two approaches is obviously with CTAs, we're trend following with futures. And we're sort of behaving in a way that's a little bit like someone who's hedging an option, in the sense that when the price starts to go up, we will buy. If the price continues to go up, we will buy more. And so we're effectively increasing what an options market maker would call our delta as the price is increasing. Now, you can do a similar thing with options, which of course is if you think the market's going to go up, just buy a call option. If you think the market's going to go down, just sell a put option. And the advantage...
I would rather buy it if you think the market's going to go down.
Yeah, sorry, good point. Hard to believe. I used to be an options market maker a long time ago. I've obviously forgotten the basics. The advantage of doing it that way is obviously when a trend turns, we as futures traders, we have to get out of our positions quickly and sell quickly and try not to take too big a loss. But obviously, if you've constructed the same kind of position with options, the option delta automatically reduces as the market sells off, and you're kind of limited to losing only your option premium when you if the trade goes horribly against you. So you can kind of think of that as similar to having a stop loss, which is something that Moritz, of course, is quite fond of. So the option premium is kind of like a stop loss. It's the most you expect to lose, but unlike a stop loss, it's guaranteed. You definitely, if you're only buying options, you definitely can't lose more than your stop loss. So the question comes kind of, well, why not do this? Why bother? Trading futures when you've got this choice of options. Now the difference, of course, is that people who buy options, generally speaking, are paying a premium. They're paying a premium because they're paying somebody else to take the risk for them. And that's why selling options consistently, selling straddles, for example, is a strategy that you expect in the long run to make a positive Sharpe ratio. If you have the data, a very good thing to do is just plot the price of the VIX, the back-adjusted futures price, which will include any money you make or lose from rolling the future, and it's pretty much a straight line going down, with of course spikes upwards whenever things go badly wrong and the VIX spikes up. So you're basically, when you're buying options, you're essentially transferring risk, and that should have a cost to you. So in the long run, you would expect that trend following through buying and selling options would be not as good as doing it through futures because of this option premium. So the nice thing about this article that I really enjoyed was as someone who likes to see evidence, what I've described as kind of an intuitive argument that you'd expect to work, but these guys actually examined the evidence and looked at this, and basically sort of compared these two approaches. And obviously this is a pretty topical subject, because exactly as we've been when we're discussing performance in March, if you were to try and jump on those trends in March that then reversed quite quickly in mid-March, obviously if you'd done that using options, that would have been, you'd have had your losses limited, whereas as a futures trader, you're whipsawed, you had to get out of your position and so on and so forth. What these guys did was look at various kinds of what they call straddle strategies. So effectively doing this trend following using options versus the kind of classic trend following using the futures. And basically, as you'd expect, over time, the option strategies gradually lost out to the classic trend following strategy. But in the last kind of couple of months, in March in particular, the options kind of had a benefit, because and this was, I think the nice thing about this article is, after any big market move where a particular strategy is done badly, it's very easy to, especially if you have pushback from clients, to kind of sort of try and what I call fit your strategy to the most recent disaster, or as a military strategist might put it, fighting the last battle. So it's very easy to look back at March and say, wow, this is crazy. What we ought to be doing is doing our trend following using options rather than futures, because we'll be protected against these savage reversals. But there's this nice evidence showing you that over the long run that's still a bad idea, because you are consistently paying up for the option risk premium that as trend followers we kind of don't have to worry about.
Yeah. What are you thinking, Moritz?
Yeah, I think it's a good article. Obviously, the link has been created many times before between option-like payout profiles or straddle-like payout profiles and trend following returns. And like Rob says, there are some similarities. For instance, when you think about the delta hedging or the replication of a call option, essentially, right? Buying more delta as markets rise. All of that is true. Now, what we have to remember is that we as trend followers, we realize the P&L every day. And when we hit our stop loss, as I do, then the trade is over, right? And you've realized the loss. Whereas with an option, say if you've purchased a call option, yes, you've paid that premium up front, paying implied volatility, maybe too much, right? That's why the implied vol premium is existing. But you will always have the benefit of owning that option, right? So the option may come back, even if the market, say, drops 20% and the delta of that call option is zero. It is still an option, right? It may be worth zero now, but it may again be worth something in 3 months' time. And, you've paid for it, you own that right. Whereas this is the difference really to trend following. We would have to go back into the trade and start realizing P&L again and pay for the benefit, if you will. So those analogies, you always have to remember that, with options, there's so many dimensions. It's strike, it's maturity, and I guess you can fit many things in order to match nicely up with trend following returns, but it's not that simple. It's two very different concepts, and one of the points which I think is important, and Rob kind of like alluded to that already, is the fact that when things really happen, in that instant, in that moment, when the market turns, right, that straddle position. I mean, the straddle position, which is at the money call and at the money put at the same time, that has the maximum vega that you can get from any option position, right? So if stuff moves and if volatilities rise, that position is there right away and it protects your portfolio. You've paid for that, but it's very, very protective at that moment. We, with our trend following portfolios, we are very likely to look the other way at that time because we're not yet positioned for the turn, right? So we're probably making a loss. And, when I look at my returns, most of the time this is true. When something really bad happens in the equity markets, I tend to be positioned long because that, drop comes in a bull market, it drops off a cliff. The straddle will immediately make money and I will lose on that day. So on that day, it's very different. And this is also one of the reasons why the scatter plots that you see, see that scatter plot that shows the S&P return on the x-axis, plus and minus, and on the y-axis you have your trend following returns plus and minus, right? And then they kind of like fit a regression line, like a polynomial regression line, and it shows that smile. Well, in my observations, that smile is there if you look at periods, if you look at monthly or longer periods of return, then you can start seeing that smile, because eventually the trend will establish and we will get on the right side of the trend. If you do that with daily returns, I've never really seen the smile. Exactly because of the reason what I've just said is when the things start moving, we're actually doing the other thing, right? So it is those, when people talk about the similarities, and I'm glad that Nathan said it's very coarsely or only roughly similar. It's not an identical thing, right? And the similarities, yeah, to a certain extent they're there, but to many other extents also they're not. And like I say, you have to go out, a lot of those plots are then fitted to show the smile, and they're deliberately created in such a way that they're only looking at monthly or longer returns to show the smile, because in higher granularity it doesn't exist.
Yeah, I want to stay a little bit with that smile, so to speak, because I want people to try and visualize this a little bit more in depth, because it's actually one of the key points. Maybe you could say it's a little bit more of the theoretical argument for what investors are looking for on one hand, but also why trend following, but also other things I'd like to talk about, may actually be really good. So again, as Moritz described, the smile comes from the fact that these strategies, or any strategy that can deliver really strong returns when a lot of things happen in the underlying, say, the equity markets, in this case, when they have big moves, either to the upside or to the downside. But when nothing happens much, that's kind of the bottom of the smile, which we then relate to the shape of a V, essentially, which is the same. And the bottom of that V, if you did it as a straddle, would be below zero, meaning it would cost you money. If nothing happens, that strategy would cost you money. So what you're trying to do in some ways is to say, how can I construct a strategy that has the same profile, so the V profile, but where the bottom, I don't even know what the Greek or technical term for this, but where the two lines meet in the middle is not below zero. is it possible to have a strategy that doesn't cost you money but still delivers in these two extremes? That's the perfect strategy. It's kind of saying you want something that is negatively correlated when markets go down, but it's positively correlated when markets go up. That's essentially what you're trying to do. You don't want something that is negatively correlated all the time or positively correlated all the time. And of course, in our world, it comes out as we say, well, we are non-correlated. But if you were looking at just down months and up months, you would see that more sort of picture of negative correlation when equities are really struggling and positive correlation ideally. And so it's kind of a conditional correlation. So certainly we know that, as Moritz again pointed out, on monthly data and people who have got long track records, we can demonstrate that that's pretty much what our returns look like. And this is why it's so attractive, really, because people shouldn't lose money with a trend following strategy if you're invested long enough, but you should still have the ability to do well, either in strong bull markets or in strong bear markets, so to speak. But there's also other ways you can do that. And of course, we've talked about some other tail risk strategies from time to time. And of course, in the last few weeks, it's become very topical to talk about. And but what I find often, it's kind of a choice, right? It's kind of a choice of either the long vol strategy or the short vol strategy. Now, on our side, actually, internally, funnily enough, I was talking to my colleagues about this yesterday. We have actually developed, and I talk about this a little bit sometimes, that in our strategy, we have a small allocation to vol or to the VIX. And people can buy it separately as well. But that is exactly designed to deliver that smile, but without that cost as well. So a different way of trading volatility, but where you also get that nice payout. And certainly this year has been a good test of that theory, and it's come out with, flying colors, which is great. But I think that's really what the appeal is, and I think it's then up to us as managers to, come with bring the narrative so that people understand that this is possible. Not every strategy has that possibility, and we know, of course, for a fact that if you're a long vol, if you invest in a long vol strategy, you can have years with negative performance until the payout. I can't remember if it's in this paper where they say that you have to go like 14 years, and then in the 15th years, when you just had that big blowout we had a couple of weeks ago, then it kind of catches up, right? But nobody can sit there and look at a strategy losing money for 10, 15 years before they get the payout. I don't think so. And then on the other hand, we know that you have these short vol strategies that work beautifully for a period of time until, of course, they blew up when we had the big spike. And we know that happens from time to time. So I think if you can construct either pure vol strategies that looks like the CTA smile, as it's often referred to, or if you have these trend following strategies that also deliver that profile, it's really appealing, I think, for investors to incorporate that in their portfolio. So those are some of the things that I take away when I see something like this.
Your memory's very good, Moritz. It's in the paper they say 15 years. I mean, there's a great quote from that paper which is this: as we like to say, risk cannot be destroyed, only transformed. And I think that's something we should always remember, that it's unlikely there really is this Holy Grail strategy, as you say. So anytime you sort of transform your risk by doing something like, for example, taking the S&P and trend following it, or trading options on it instead. Ultimately, you're just changing you're always exchanging risk for a different kind of risk, or exchanging risk for return. There really are these sort of no free lunch. Generally speaking, if you think there is a free lunch, then probably there's something wrong. You've probably found the next Bernie Madoff, perhaps. It's important, definitely, that investors understand what the strengths and weaknesses are of different kinds of strategies, and have realistic expectations of when they do well and when they do badly, and ultimately the best thing generally is to be diversified, and to have all of these things in your portfolio, a bit of long vol, a bit of short vol, a bit of CTA stuff, maybe a little bit of tail protection, if it's not too expensive. The other thing the authors point out is that a lot depends on what your own risk preference is. For me personally, I'm happier to pay less of that kind of underneath the V cost by trend following, and give up some of the certainty of the fact that when the market reverses, during my holding period, which is kind of what Moritz was talking about, I know I'm not gonna, I'm gonna end up paying to get out of the position. Whereas with options, I get that for free. That's that's a payoff I'm personally happy with. But one of the nice things about this paper is it really makes that choice stark and says to investors, okay, this is what's on the menu today. Neither of these dishes is perfect for you. Depends on your preference, but now at least you've got a good understanding of what the likely payoff profiles of these kinds of strategies are.
I think that's one other thing that's really important in this, which a CTA smile doesn't actually show in a sense, and this is where it becomes a little bit tricky, because we can look at it and say, oh yeah, if the markets move a lot to the downside or to the upside, a trend following strategy or another kind of strategy will do well. But there's another twist to it, and Moritz was alluding to that a bit before, and that is speed. Speed doesn't come into this. And actually what I find really fascinating and interesting, and certainly some of the things that I'm excited about on our side in terms of our research, is that our vol strategy actually has the ability to react instantly, right? I mean, it's there to react to these spikes in vol, which we know already that is impossible for us to do in our trend following part. And this is why I think, and so if you look at it from an investor's point of view, we've always talked about that you should probably have a bit of short-term trend following and a bit of longer-term trend following, because the short-term guys will do well initially. So that's going to help you out there. But the longer-term guys, we know from the data, will do better if the crisis persists, right? So maybe instead of saying, okay, it's short-term trend following versus long-term trend following, I mean, you could also, as certainly as we're trying to say, okay, you have a vol strategy that can react really quickly and will pick up that uncertainty as it happens. Combine that with trend following that will ride out the storm as it just keeps growing and you have this major crisis. And then combined with those, combining those two things, you actually have a pretty good shot at helping your equity portfolio. But maybe we're going to be talking about bonds just as much in a few years, where that's where the risk is. Who knows? But I think some of those strategies are really the future. I think in the way investors get the ultimate protection of their portfolio, again with an expected return. We're not expecting them to pay for this at the end of the day. We're still expecting them to make money from this, but with all the other benefits.
Maybe one final word about this is right now, I think, probably VIX is around 30, somewhere around that. We've had it much, much higher about 5 weeks ago, as people know, I guess, as our listeners know. And, it's very expensive in historical comparison to put on a long straddle position right now, because you're paying for that volatility. So my trend following strategy isn't impacted by that. It doesn't cost me more to put my trend following strategy to work and trade if volatility is 30 or 10, because my stops and my position sizing and all of that takes volatility into account. So I've said it before. I guess there's people out there who are, and I have similar background as Rob in this. You can, I guess, be a systematic market maker in options and vol and all of that and make money that way. I still have to find the systematic vol trader that is consistently profitable. I haven't found that. I've never seen a track record like that. All of those vol traders seem to be discretionary, all of the successful ones, right? Because there is an element of, okay, you need to see where the flow is. You need to, tap into the banks, recycle some of the risk. It's so multidimensional across different maturities and different strike prices that, and all the asset classes and how they link to each other, that it's, I think, virtually impossible to systematically make money in that way. And all of these successful vol funds are, in a way, discretionary, I think.
So just to say, actually, that AHL, where I used to work, been trading vol systematically for about 13 years. So,
But
what I mean, of course, you can systematically short vol. I'm sure that is easily done.
It's not just shorting. It does have a short bias. Like all vol funds will have a short bias if they've got a positive expected return. There is stuff you can do. I kind of agree. I mean, it's very difficult, like getting the data and the surfaces and interpolation, and there's a hell of a lot more work to do before you even think about calculating a signal. I'm inclined to agree with you that I think that the best vol traders are still discretionary because of. But there is stuff you can do in that space. It will, generally speaking, be short bias because of obviously that's where the expected return is.
I couldn't agree more with you, and I think it's so exciting because I know you know your stuff more. It's when you say that. And so the most exciting thing about that is that we've actually done it. So our vol strategy, because we don't want to do anything discretionary on our side, our vol strategy is 100% systematic. And you are completely right that it is difficult to do.
I'm not sure how long your track record on vol is and what type of instruments you're trading, whether it's just the VIX. This is one volatility instruments out of so many out there. I'm talking more about diversified volatility trading across asset classes, across instruments. Doing that systematically is incredibly data intensive, and it's incredibly difficult to do because of the amount of the data, because of the multidimensionality of the data, and because of the data being crappy to begin with. The stuff that you see on an options order book is not necessarily the stuff that you can trade. A lot of that volume is traded OTC. So, we don't see it in the same way that we don't see futures markets. So systematic vol trading, to do this properly across all of that is incredibly difficult. Of course, you can look at the VIX future and come up with a system to trade that systematically. And like Rob said, I guess most of them are short biased, because how else would you have a positive expectancy? I mean, you have to come up with a heck of a system to trade that from the long side, right? And so my point is, right now with vol at 30, yes, you can. I have no forecasting ability, right? Maybe we've entered a new regime with volatility and it's going to stay elevated and go higher for the next 1 or 2 years. I have absolutely zero idea. Maybe we're down to 20 in 2 weeks' time. Could be just as likely, right? But when the stuff traded at like 9 vol, or I'm not sure what the all-time low of the VIX was, but somewhere around there, right? It's kind of like, if you can pick some of that vol up and buy convexity, that's probably a good idea to do.
Yeah, no, I mean, I completely agree with you that obviously if you want to be systematic, you can only trade the markets that are liquid and all of that. And that is the equity side and the VIX and the S&P options, et cetera, et cetera. So I'm not claiming we've done it across all asset classes for sure. Absolutely agree. Of course, with all strategies, right? Of course, I mean, with all strategies, there's going to be periods where you don't make money. So of course, there's going to be vol environments where we're not making money for sure. The question is, like with trend following, there's no difference. We know that people like these strategies that looks like they're making money all the time, but they're doing it because, as you rightly say, they have a short bias, and so they're going to be making money for a long period of time, a little bit, and they're going to be completely run over when vol spikes. So, but anyways, interesting discussion, and I'm sure there's going to be more of this as markets continues to become difficult, and I suspect it's not just going to be equities that will be the difficult markets in a few years' time, maybe sooner. You had more articles that you had picked up, Rob. One, of course, which I guess also is one of those legacy stories from what happened with COVID-19, when oil went negative, but also what that meant for people who are in that business, service providers, brokers in particular. We know that there's been some big losses reported. And so why don't you talk a little bit about the next piece that you found?
Yeah, I mean, the whole oil going negative is really fascinating from a number of different aspects, actually. So one is the sort of expectation amongst a lot of people that the price, any price can't go below zero. And actually, for me, there was a real parallel with about 8 or 9 years ago now, when interest rates started to go below zero. And at the time, I was managing a fixed income part of the CTA portfolio. Obviously, was quite focused on this. And I think it was Swiss LIBOR that first went. The future started trading very close to 100, which, if you understand how interest rate futures are priced, that means the interest rate was about to go negative. And we were having this big debate about whether it was even possible for the underlying instrument, which is the actual LIBOR fix, to go negative, whether it was even possible for the futures to go above 100. And one of the nice things about the way we designed our system was it was actually quite agnostic about the level of the price. It just treated it as a number. It didn't really have an understanding of what going above 100 meant. So from a sort of operational perspective, everything was fine. It was just more of our kind of research concern about whether that this different interest rate environment was something that really we could rely on our back testing. Was there something special about that the yields going below zero that meant that we had to throw away all of our back tests and potentially refit our models or stop trading the market entirely. But from an operational perspective, everything actually worked pretty well. And now, of course, negative interest rates in Europe are fairly common. And Mr. Trump actually would like some in the US, so that's something he'd like to import into his country. He thinks they're a wonderful thing. But with oil, the same thing. I mean, the thought of having a negative oil price seems pretty crazy. Like, how can the price of a physical product be negative? Interest rate is different, particularly something like LIBOR, which of course is just based on a survey, still even to this day. And one of the larger brokers, Interactive Brokers, it turned out that their system didn't know that the price could go below zero. And in fact, the lowest price it was showing was 0.01, I believe. And so one retail trader thought, well, this is a great opportunity. I can buy a barrel of oil for $0.01, and I'm going to buy loads of crude oil futures, and nothing can go possibly wrong. But what he didn't realize was that the price was actually negative. It's just that the system was unable to show him that price, and he ended up with quite a big loss in his account. But of course, because it was down to an operational failure on the part of the broker, they had to make good that loss to him. That's the first thing that kind of jumped out at me is how you really can't have any preconceived notions, particularly in these crazy times that prices can't go below zero, or back in the day that interest rates can't go below zero, because sometimes these crazy things can happen, and you need to make sure that the operational side of your systems and your infrastructure can cope with these kinds of things. So, for example, if you in my system, I guess you guys have something similar. It's running fully automated. It does need to cope with a bad data. So if a bad price comes in, you need to have some way of automatically spotting that and flagging it up. And my system automatically sends me an email, because obviously I'm just running it by myself, saying, "Hey, Rob, it looks like this price is bad. I'm not gonna deal with that." You can imagine a situation in which someone had a system that completely refuted negative prices and refused to believe they existed. Whereas with my system, it flagged up the price, and I said, "Oh, okay, yeah, that is a really negative price. That's fine. That can go into the system. Everything will just work." So, and then there are various other parts of my system that are designed to cope with negative numbers, because I had no expectation built into my system that prices could be positive. So that was the first kind of really interesting lesson for me from this event. I don't know whether you guys, whether it affected you guys or whether you just sailed through it without any issues.
I mean, on our side, we didn't even trade the May contract, so we were not affected by it whatsoever. And we would always, like I'm sure Moritz does on his side, we would always roll, ways before you get close to expiry, because that is a risky time to trade. And I'm even surprised that retail investors, like the guy you mentioned, I've seen the article as well, we're allowed to trade futures so close to expiry.
Yeah, we can talk about the roll in a minute, actually, because that's the other point I want to bring up. Yeah,
sure. But I actually think it opens up. I think what happened opens up a kind of a broader discussion, and that's kind of what you alluded to initially, where the guy thought, "Oh, if I can buy oil at $0.01, I'll be a gazillionaire because it can only go higher. Because we often talk about commodities in the sense that people say, oh yeah, but I mean, it's not going to go below production price. So there's kind of this, invisible flaw in the price of commodities. Well, it didn't turn out that well for oil. And I just wonder whether we've opened kind of the next chapter where we have to rethink what production price means, and does it even mean anything? Because if we go through a crisis where suddenly there is a massive oversupply of anything, well, then the price can go anywhere. So again, I think it talks positively for the kind of approach we take, because we don't have a prediction, we don't care. Don't care. I don't mean it in a negative way. I say we don't have a prediction about what is right and what is wrong. We just follow the price. So I think these surprises we see goes back to this philosophy of knowing what you don't know, and if you stay true to that, then you're never surprised.
I don't think negative prices are all that new. I know they've become more frequent in the more recent years, and Rob has mentioned the negative interest rates, even though one could say negative interest rates have existed before in history. It's just we haven't been around to observe them. Power prices in Europe are very regularly, very often negative. Off-peak power prices are, for instance, German power, pretty much every week now has a negative price at a certain point of the day, and it clears substantially negative, like, minus 40 per megawatt hour. So there are many segments of the market where negative prices are a reality. I think negative prices are a reality in our lives. For instance, if I want to get rid of my old fridge, it's not free of charge. There's a negative price. I need to pay for getting rid of it. If I want to get rid of my old car, it has a negative price if I don't find a seller, because, I need to drive it to a demolition site and pay for it being demolished. So negative prices are there. And what's funny about it is that the financial models out there, or many of them at least, are unable to cope with them. I'm sure changes have been made because now the quants are looking at the situation. It's like, hey, we need to cope with those negative prices. But in return space, where zero is the ultimate floor, right, and lock return space, that stuff just stops working, right? I mean, if you go from -1 to -2 in crude oil price, that is a plus 100% return. It's not negative anymore. So it's completely backwards, and I think those models have to be adjusted to cope with that. What I did, I didn't trade the May contract. I trade along the WTI futures curve, but I'm not trading every contract because the entire curve is relatively liquid. I may at some point be trading the May contract if that one is looking very preferable to trade from a curve point of view, but this year I didn't, because the curve was already in very, very, volatile environment. Anyway, I was in the June contract, so I wasn't impacted by that roll in May, right? But I forced my system in a back test to trade the May contract, and it wouldn't have been a problem because I don't look at returns, I look at differences in price, and that works in the same way below zero as it does above zero. And one of the things that I just want to bring up again, because it has to do with rolling, is the way I do that, and I've mentioned that before, is I create a continuous contract that is back adjusted for the price difference as of the point of the roll. Not everybody is doing it that way. So when I do this means I'm keeping my lots essentially constant, right? And the price is whatever the price is. Some people use a different way of rolling, a different back adjustment factor, which is based off the ratio of the contracts at the price at the time of the roll. That doesn't keep their lots constant, it keeps their notional exposure constant. The problem is, if you rolled crude, what was today, 21st of April or something like that, and it's negative, and the next contract is positive, then you're creating a negative ratio, and that negative ratio will impact the entire time series of your back adjusted continuous contract and flip it upside down. So this is exactly when even, a systematic trading process, a systematic rolling process may hit a roadblock. And it's probably not something that you would have thought about when you designed your system or designed your roll strategy. So I can only say using the differences and not creating those ratios and not creating percentage returns is a good thing.
Yeah, I mean, it's interesting because I often have debates with people who say, because I do the same thing, I use this difference approach, and people say, it's too simple, it's too crude, it's not sophisticated.
They say about trend following exactly the same, right?
These are fellow trend followers who consider themselves a cut above, and they say, yeah, you should use the ratio. That's the more mathematically correct thing to do. I've just never bothered. It just seemed to me like, to be honest, I didn't bother, not because of this issue, but because it just seemed like a bit of extra work and a loss of intuitiveness in the system for no benefit really. And the other thing about if you do back adjustment, if you go far back enough in time for something like US 10-year bonds, say, because they've had so much return from the roll down, the adjusted price does actually go negative. So if you say that
soybean meal is the first one who goes negative.
Yeah, exactly. Yeah. So if you say that the price of the bond now is, I don't know, 120, say, for argument's sake, you go back to like 1980 and the price is minus 50. So at that point, your system has to cope with negative prices already in the back test. So as we've been kind of all alluded to, none of us were trading the May contract, and one of the other things that kind of came out for me is this whole issue about the fact that essentially, when we have our back tests and our trading strategies, they're agnostic about contracts. I mean, I don't know about you guys, but in my system, most of the code works without knowing the existence of contracts. It's trading this thing called the US 10-year bond future that doesn't really exist, and you actually have to implement that by holding a specific contract, at some point you have to choose which contract you're going to trade, or perhaps as Moritz has alluded to, which series of contracts you're going to trade, and you have to make a decision about when you move from holding one contract to the next, when you make that roll decision. So like you, I was shocked that anyone would hold the front contract of crude oil, I thought it was kind of interesting because if I look across my portfolio of futures, actually, there's sort of 4 or 5 groups that they fall into in terms of when I decide to roll them, I thought it was a good opportunity. I did a little Twitter thread on the subject to say to people, look, generally speaking, there are certain rules you should follow, and then there's a little bit of flexibility around that. So if we take crude oil as an example, my personal preference, because I've only got the capital to trade a single contract, is I just trade December. And I'm lucky that in crude, December is one of the liquid months, and if I can roll from, so in where are we now? We're in May, so in about October, November, I'm currently holding December 20. I'll be able to roll into December 21, and it's sufficiently liquid to do that. And the nice thing about that is because it's a physical commodity, it does have seasonal effects. And by sticking to December, the seasonal effects effectively disappear from the price series. So that's crude oil. Whereas there are, of course, quite a few things where there isn't really any decision to be made. You have to trade the front contract. So the bonds, the equities, natural gas, then there's a little bit of a decision to make with, say, the bonds. You've probably got about a week to 2 week period in which you can roll, I would say, and then it's a question of whether you leave it to the last possible day or whether you do it early. But that's not really going to make a huge amount of difference to what you're doing. And then, as we've talked about quite already, you've got the vol contracts. And again, you'd have to put a gun to my head to make me hold the front vol contracts, because that they remove a lot. They're very volatile, and the distribution of returns has got I mean, they're all negative, positive skew, but there's a massive positive skew. And if you're generally short, that means you've got a massive negative skew. So I generally like to hold the second or the third month out. And then the other kind of contract of interest would be probably the short-term interest rate futures, where, like crude, there's quite a long series you can trade. So, the Eurodollar is liquid to 4, maybe 5 years away. And the thing here that's kind of influenced me is that if you go back a few years to when we were talking about interest rates really low and also very stable during the long period of zero interest rate policy in the US and elsewhere, the very front Eurodollar futures, the volatility on them was just nothing, absolutely nothing. And you had to go quite a way out on the curve to get to the point where the volatility was reasonable enough such that you didn't have these huge leverage positions on. So Eurodollar, I have a preference for trading about 3 years out, because much further than that, the liquidity starts to go down. So that's my kind of take on that. I'd be curious to know what you guys do, though, because obviously there is some room for debate in some of those decisions.
Yeah, speaking about short-term interest rates, by the way, did you notice that I think it was the Feb on March 21 Eurodollar that went above 100 for like a few seconds at least, either this week or last week, I can't remember.
Yeah, that's much closer than I'm trading. I'm out in like 2023 at the moment, so
sure.
Yeah, I didn't know. That's interesting.
Yeah, we're probably we're probably a couple of years out, I would imagine, on those kind of things. But of course, it does change a little bit. I guess also in terms of the expectations. So maybe that is not at least in certainly the way I've been brought up in trend following is that, I mean, you don't have to overthink your roles, right? I mean, you can pretty much set them at certain dates, like, 5 days into the month before it expires or whatever the number is. And it's usually a pretty good measure. Of course, you could also have your system tell you when in open interest changes, then your system triggers it. The systems can do that. That's not a big problem. But I think with short-term interest rates, I do think we all had to rethink that once a few years back when yields went so low and we had to move out further than what was the norm, at least in the old days, for sure. I think the norm in the old days was like 9 months out is how a lot of these roles were set up, but that's probably not enough anymore, I would imagine. So...
Yeah, I think Rob made a very good point on the seasonality of some of the contracts. It's not only in the energies where, for instance, in nat gas you have winter and summer, but it's also in the grains where there's old crop, new crop. And if you stick to a certain contract or two contracts, say a year, and they're liquid, then you can kind of circumvent the seasonalities of that market. And I think this is worth looking at. Just leave it like that. There are other contracts, such as, for instance, WTI, where you don't really have that seasonality, and the curve is liquid. Yeah, December is liquid, but all of the other contracts, at least for my size of trading, they're also liquid enough to trade. And so therefore, for me, what I'm doing there is I'm looking at the strip and, the full calendar, and depending on whether I'm long or short, I'm looking at the shape of the curve and the roll yields that are implied by the curve, right? And then my system may take one contract or another. But this is why I've said next year it may be trading May. It didn't trade May this year, but maybe next year it does, right? Right now I'm in December already. I rolled from June to December, so. There's some other things that you can do. Obviously, when, for instance, in coming back to crude, if you're in the front contract in April, so you're in the May contract and you're short, that one, of course, gave you the most bang for the buck. It obviously also gave you the most volatility. So, it's a give and take. June never went negative. Only May did. So I'm not saying that it's impossible to trade those contracts, but like Rob was saying, they tend to be more volatile, because that's, where the action it gets into delivery, and people need to get out or they get squeezed, and it's just more action being in there. Other markets, such as, for instance, say the Hang Seng, right? The Hang Seng it's kind of like, you have to be in the front, and that stuff is rolled kind of like in the last 3 days prior to last trade, and it's kind of like that's the window, and you're in that window or you're not. It's, you don't want to roll it any other day, because that's when the spreads are liquid. And so then you just have to deal with that and be in the front and roll to the next front, because nothing else is liquid. And
Very true.
Nothing more to add. But I think it is, especially in the commodities and in the short-term interest rates, it is a fruitful area for research.
So I should have said I also follow this approach of sticking to a specific month for the commodities when I can, so corn and so on. I think the other contracts where looking at the roll yields or the risk-adjusted roll yields, which essentially is the carry signal, I guess, is interesting, is in the VIX and the V stocks, because you've probably got about a 3 to 4 month range in which you can look at positioning yourself, and particularly at the moment, if you look at the curve for the futures curve of the VIX, it's kind of crazy, right? I mean, it's kind of wiggling up and down, so you can actually have quite different roll yields depending on the month that you're in. And absolutely, the Asian markets, particularly Korea, which I've said before, I've traded, and it's actually Jerry who DM'd me on Twitter and pointed out to me that I should be careful, because US citizens can't actually trade the Korean futures. So that's a message for the US listeners. But the Korean bonds and the Korean equities, again, you've really only got maybe one day to roll them. So you really have to get your skates on there.
Well, maybe with Trump's new friends in that area of the world, maybe they can trade the North Korean futures market soon. You never know. Anyways, we've got a hard stop today in terms of time, in about 8, 9 minutes, 10 minutes maybe. So let's move on. The last topic you brought up, Rob, was actually a tweet from our friend Jerry about systematic versus discretionary. So in a few let's make it short this time. What were the key takeaways you took from that?
Yeah, so Jerry actually, it was an article in The Economist, which is one of my favourite publications, I have to say. Although I should point out that annoyingly it is behind a paywall. So, but it's kind of every, journalists like beating up the fund management industry with a stick. I think what journalists tend to do is they'll look for the weakest victim and then hit them a few times. So obviously over the last few months, active equity managers have not shone, and active hedge fund managers, long short managers, have done very badly. And I think value, I've seen quite a lot of articles saying that value in the US, for example, is as cheap as it's ever been. I mean, it's just crazy cheap, like value stocks. So anyone who's doing any kind of long short equity with a value bias will have underperformed the market. So the Economist has taken a big stick to the hedge fund management industry in general. But one kind of bright spark that we can take from that article is that the systematic side has done well, and the quote that Jerry has pulled from that article is that on average, around a third of hedge fund assets are managed in systematic funds. On average, these have done best, minus 2.1% this year. By contrast, discretionary funds run by humans are at minus 12.7%. So, I think in the CTA world we've done a bit better of that. I think the indices are profitable. All three of us around this table have made money this year. So, but sometimes you have to take the credit as a relative performance rather than an absolute performance. And I think the shift in the industry from discretionary to systematic, which sometimes is 2 steps forward, 1 step back. I do think that if this outperformance continues, I think we will continue to see a shift out of discretionary fund management. There are areas where discretionary fund management makes sense, and indeed we've already talked today about discretionary options trading. I think in more liquid assets, perhaps in some emerging markets where you can't really trust the data and you have to use human analysis. I think a third a third of the industry is systematic to me still feels too low. I think it should be at least 50-50, if not higher. It seems weird that, given that there's a general trend in society that AI and robots are going to take over everything, that most fund management is still done by guys, thinking, and as both the evidence and the science suggests that with the exception of a few superstars and in a few niche parts of the industry, that they're generally going to be outperformed by systematic decision making.
If it's a double-edged sword. Maybe if more money gets systematic, maybe it becomes more difficult for us to make money. Maybe one of the reasons that we have an edge is that there are still quite a few discretionary managers who come up with decisions that may be suboptimal or apparently are suboptimal, and we take the other side of those trades potentially, right? So if everybody becomes systematic, maybe my life becomes a bit more difficult in terms of return generation. But I mean, the other thing is systematic. We've said this before. Having a plan and having a system and being able to stick to that system has so many advantages. I mean, when things become wild, at least you have that guidelines and your system that you can stick with and follow. And I give you the example again with crude. I know we've spoken about that a bit, but discretionary Moritz, which didn't take any positions, but when I looked at the market at -39, right, in super contango across the curve, and this is less than a month ago, this is like 3 weeks ago, right? You look at this market, discretionary Moritz goes, well, they're producing oil, we have this virus situation, nobody's driving, and that market is toast. Crude isn't going to come back up. Okay. 3 weeks later, the May-July spread is in backwardation. It traded in backwardation yesterday. Only a little bit, 10 cents, but this coming out of like -$11 contango, right? And supply has been apparently reduced dramatically. Demand is picking up. Some of those cars are on the road again. And within a matter of 3 weeks, that market has done essentially a 180, right? Maybe it's now going to go down again, but had discretionary Moritz taken any positions, I would have killed myself, right? P&L wise. So it just again and again shows that whatever you think will happen and what factually does happen are two very, very different things. And I experience that all the time with myself, where you come up, you read something, and you form an opinion, and then you don't take a position. But 3 weeks later, you read about it, and it's like, oh well, lucky me, I didn't take that position.
I like that hashtag discretionary Moritz. That's a new one. Let me jump straight to a quick question that Brian sent in. And Brian was generally interested in maybe we could talk a little bit about where we see the strongest trends in our portfolios from a signal point of view. We may do that more from time to time. Certainly, from my point of view at the moment, not surprising. I mean, short energies are still reasonably strong, and some other commodities like cocoa also in that region in terms of strength, and then obviously on the fixed income side, but this time on the long side, we do see a couple of the fixed income markets. So that's kind of where, and then there's a lot of not very convincing signals either way, so to speak, Brian. And but we may comment on that. Let me just quickly, because again, we have a little bit of a deadline today. Speaking of positive performance, we can quickly run through where we stand for the CTA space industry. This as of Thursday evening, Beta 50 up 0.66 for the month of May, still down 1.29% for the year, but that is the only index that's down for the year. We now have the SocGen CTA index up 82 basis points for the month, up 52 basis points for the year. SocGen Trend Index having a good month, 1.29% up, 3.78 for the year up. SocGen short-term traders index up 47 basis points for May and up 4.39% for the year. And the Bridge Alternatives, the flat fee index, up 73 basis points in May so far and up 3.52% for the year. So all in all, things are well across the industry at the moment. Any final thoughts? Let me start with you, Rob. Any final thoughts from you?
Yeah, I mean, I pointed out last time that it was going to be my birthday a few days before this podcast, but my cake doesn't seem to have arrived, so I'm quite disappointed.
Oh, it's a virtual, Corona, we're not allowed to get out. We tried, but we just couldn't.
Okay, I forgive you.
But there we are.
Exceptional circumstances.
Yeah, there we are.
No, it's been
it was really good. I mean, we had to eat it, of course. It was really good. Yeah.
Okay.
Yeah.
No further thoughts from me.
Belated happy birthday, anyways.
Well, it's upcoming, right? The birthday's upcoming.
Is it upcoming
No,
or it has been?
It was a few days ago.
Okay, so happy belated birthday, Rob.
Happy birthday.
Yeah.
Any final thoughts, Moritz?
No, leave it with a happy birthday. I think this has been good.
Fantastic, good stuff. On that note, we're going to wrap up this week's conversation. We hope that you enjoyed it. And as usual, by the way, send us your questions to info@toptradersunplugged.com, and we'll do our best to give you an answer as soon as we receive them. So from Rob, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.